Hey guys, welcome back to another episode of Market Champions. Today we've got Brent Donnelly, who is a senior FX trader. He's traded at places like HSBC, Citibank, and hedge funds in Connecticut. So thank you so much for being on the podcast, Brent. It's awesome to have you here.
You're welcome. Glad to be here.
Absolutely, my pleasure. So Brent, could you tell the audience a little bit about who you are in case they don't know, sort of a brief summary of your background and your journey on Wall Street?
Sure. So I'm Canadian. I went to school in Canada and then I started at Citibank Toronto as an FX trader. And in those days, the analyst program was a little less sophisticated than it is now.
Mhm.
So basically they said, oh, we have three seats. One's in structuring, one's in T-bills, and one's in currency trading. So why don't you go sit with those people and see what you like? And I was like, T-bills don't move. Structuring's too like cerebral for me. So because I wanted to be a trader in the like liar's poker kind of era. So I was like, okay, currency trading looks good. And that was 1995. So 26 years later, I'm still trading currencies. So I think I got a little bit lucky. So my path was initially when I started, currency trading was very transactional. So there was no macro. There really wasn't even like a prop trading per se on bank desks. It was just straight flow. So you were just trying to keep your position and try to like not get your head ripped off by flows as they came through. So it was fun, but it was fun in the way that like dealing or playing blackjack all day would be fun, kind of like a little bit mechanical, and you didn't really control your own destiny that much because mostly what you were doing was just processing other people's flows and ideas. So I've always had the tension between creative and math kind of pursuits in my head. So at that time, a friend and I were writing a movie script, and I was like, I don't know if this currency trading's for me. It's a bit like, it's not like that intellectually stimulating. It's a bit mechanical. So what the hell? I'm only 23. I'm going to take a shot and go try to make a movie. So we were pretty naive, very naive, I guess. And so we tried to raise the money for the movie and were unable to do so. But in the meantime, we wrote a cartoon. We created a cartoon that got bought by a studio in Montreal. So we
Wow.
got a chance to, yeah, that was fun. So we wrote 13 episodes. They were on TV in Canada. But then at the same time, so that was kind of like semi full time writing the cartoon. But then at the same time, the NASDAQ bubble was starting. So I had a little bit of money left from my time working in New York for Citi. And so I put that money into an account and then started trading. And the way that I was trading was very, very successful for about like 3 or 4 years, well, about 3.5 years. And I can talk to you about that after if you want. But basically, I was making a lot of money trading the NASDAQ bubble. And the show was on TV. So it was kind of like awesome times. And then around 2002, my methodology stopped working in trading, and I can go through that and why that taught me a big lesson about adaptation. And also the show got canceled. So then I was like, oh, now I'm like 28, 29. Maybe I should think about getting a real job. So I went to work at a bank, and then I ended up at Lehman Brothers. And then I kind of like really found the job was amazing at that point because instead of like there was still a flow aspect to it, but much more of it was just like thinking about markets, thinking about like where's euro going, where's Aussie going, how can I monetize that view, and then how can I share that view with clients as well, because that was the way I kind of found my piece with being creative and being like math oriented, is to find a way to express myself. I write this daily called AMFX, and I,
Mhm.
obviously it's not like writing, poetry, but it has like a creative element. I try to be like a little bit independent in the way I think and the way that I look at things, the way that I run the numbers, but also the way that like I view the narratives and surf the narratives. So I was able to find kind of like a perfect balance between creative work and more mathematical puzzle solving and all the stuff that I love about markets. And so that was, I realized kind of like was my sweet spot. And so then when Lehman went under, I hopped around a little bit. But generally what I've been doing pretty much the whole time since 2003 is trading FX and writing about FX. And then I'll dabble in some other stuff like rates and stuff like that. But generally what I've found is a couple of things is that when I'm dabbling in other markets, my views and positions tend to be very correlated to my FX position anyways, because I tend to be very directional and not relative value. I'm not an RV trader, and I've never really enjoyed that. So it ends up being like you can be long dollar yen or short bonds. And if you're already long dollar yen, for me, a lot of times it's better to just buy twice as much dollar yen than it is to get short bonds. And then you just have two highly correlated positions to manage instead of one bigger position. So that's kind of been my path. And then in the meantime, over the last couple of years, I've also written a couple of books just because I've had a lot of, a lot of thoughts and I've written so many AMFXs since 2003 or whatever, that, I've written a lot about trading and strategy. A lot of what I write is just about individual, like tactical ideas and things like that. But then I also write a lot about the mindset and psychology of trading and position sizing and like all the kind of nitty gritty stuff that goes into, actually succeeding at trading. So then I thought, I might as well write a book about this. And then the first book was more about currency trading. And then the second one is more just about trading in general, like mindset, and methods for trading, which kind of applies hopefully to all sorts of trading.
Yep. And, when it comes to currency strategy, I at least in my opinion, I think The Art of Currency Trading is one of the best books out there. And that's the book by you. Yeah.
Thanks.
So, when you got started in 1995, that was still sort of the days of, Soros and Druckenmiller. And, just 2 years after that, you had the Asian financial crisis, and, we saw Soros break a lot of pegs in Asia. So how has sort of, how have markets evolved, from when you've started trading and, 26 years after that?
Oh man, so where do I begin? I mean, obviously, obviously, the biggest evolution has been the electronification of markets. So that has a lot of implications. The first one being on the market making side is that the job of being a spot trader, which is what I do, has been automated to a great extent, which to me has been a very good thing, because much like in any industry, generally when things are automated, the more boring and rote tasks get automated away. And then what you're left with is the more creative and difficult and multi-layered tasks, which are humans are better than machines at. So if you look at like a GM plant, the jobs that get automated away are the really boring, turning a widget on a conveyor belt. And what remains is more like process design and interesting jobs. So for me, that has been a big benefit of automation, is that it has stripped away the boring, or not really boring, but the less interesting part of trading. But the negative part of that is that, so when I started at Citibank in 1995, there were 30 people on the spot desk. You had like small, medium, and large size, and in fact, we were actually trading dollar mark at that time because it was before the euro. So there was like Mark Paris and Mark Lira and all that stuff. So your older listeners will appreciate that reference, but younger listeners will not. So the thing with that was there were so many jobs because every single flow had to be handled by a human being. And now most of the flows are handled electronically. So now a normal spot desk is 2 or 3 people, and it was 30. So there's been a massive downsizing in terms of number of good trading jobs that are available. But to me, the remaining jobs are way more interesting. So that's great. So that's on the market making side. And then on the trading side, or like the thing that everyone would experience, even if they're not market makers, is the rise of algos. So and again, actually, this is another way to think about, or another example of why adaptation, I think, is really, really important in trading in general, is in 04, 05, that's when the algos really started to appear, and they became much, much more prevalent after the crisis. But I would say around 04, 05 is when you started really noticing that there was a difference in markets and behavior. And it was interesting to see how people reacted, because a lot of people were like, this is BS, this market is broken, like this is garbage. And then some people were like, how do we beat the algos? And like that kind of represents two very different mindsets. One is, which is like a lot more fixed and like, this sucks, and what, like kind of complaining about things. And then the other one is like, oh, there's something has changed here, I better pay attention. And, how can I adapt to that new thing? And so going back to what I said before, the thing that killed me in '02 was my methodology was, I won't go into super deep detail because it's not that interesting, but the general idea was I had like 6 or 8 very high priced stocks on my screen, and I had a future squawk to the S&P pit, and I had futures on my screen. And when futures started to tick higher, I would get on the bid in like 8 high valued stocks that were all trading pretty wide bid offers still at that time. Just an interesting side note. So in 1990, I guess it was 98, 99 when I was doing it, when I started, I would, every morning I'd print out a sheet of all the stocks above $100. And it was usually around 3 or 4 pages. And in 2002, it was 3 stocks at one point. So the absolute value of all the stocks collapsed. So by definition, then the spreads got narrower, but then decimalization happened. So the way stocks were quoted pre 2002 was in fractions, and that lent itself to wider spreads. Just, I think partly human nature, because you could still put weird fractions like 1/256 in a lot of stocks, but people just didn't tend to do that. Some dude calling up on the phone to buy 100 shares of E-Trade or whatever just would generally leave an order at a quarter or maybe at an eighth. So by definition, those spreads were just wider. So when you went to decimalization, a lot of stocks were then trading 1 or 2 cents wide. And so my strategy just didn't work anymore. So one interesting takeaway from all that, though, was that pretty much the whole time I was always gross positive. My strategy still worked on a gross level. But the problem was that I wasn't net positive once decimalization happened. So I was still extracting money from the market, but not enough to cover commissions. And I mean, that's, I think, a hugely relevant point that a lot of people miss, is that you think about, like, if you're trying to be realistic, I mean, some people are just unrealistic and overconfident when they come into trading. But if you're trying to be realistic, you're like, okay, this is a zero sum game. I got to have some serious edge in order to make money, because there's a lot of, Harvard PhDs and computers and Renaissance and Jim Simons and all that. Like, you're competing against a lot of firepower. But the thing is, it's actually even worse than that, because it's negative sum, right? So every time you trade, you're either paying some kind of commission, you may be displaying some latency to an HFT, you might be paying a bid offer. It doesn't matter whether you're paying commissions or not. You're always paying a tax to get in and out. And whether that's measurable or visible, like, that's a whole other discussion, but it doesn't matter. You're always paying to get in and out. Even as a market maker, you're still paying, because you're still paying a little bit of brokerage. Even if you're getting hit on the bid every single time, you're paying brokerage. Or if you work at a hedge fund and all you do is leave limit orders, you're still paying prime bro fees. So, like, there's just an ecosystem, a financialized ecosystem extracts a lot of rent, and you got to pay that rent no matter where you're sitting. And so I think that's just, like, people need to realize it's a whole other level of difficulty, because many traders that I've seen, like, especially on the day trading side, like on the retail side, can generate positive returns because they have some small edge, but you have to be able to generate returns in excess of transaction costs and slippage, which is harder. And then really what you should actually be doing is generating an expected income that's in excess of the opportunity costs, because, like, obviously if you weren't trading, you could be doing something else. However, trading is way more fun than pretty much any other job. So to me, like, even though success rates are very low, it's commensurate with any if you look at any industry where there's a low barrier to entry and a very high income, it's hard, you know, the success rates are going to be very low. So like if you want to be a rock star or a professional athlete or a pro poker player or a you know, a day trader, all those things have no barrier to entry essentially, or very low barrier to entry.
Yep.
And very like shockingly high payoffs. So I think it's logical that by definition that's going to have a low success rate, or it wouldn't make any sense, or the payoffs would have to be diminished if it was easier.
Yep.
So there's like, I think one of the chapters in one of my books is called like, if it was easy, it wouldn't pay so well. I mean, that's kind of like the definition of most pursuits that are worth doing, whether, and it doesn't have to always be about money, but like, if you want to be like the best poet in the world, there's probably going to be some struggle and pain involved. And that's part of what makes it worth it. And to me, that's kind of like the way that I look at trading, because there's been a lot of pain, like, you know, various, you know, having bad years and bad moments and, you know, bad trades and all that. Even if you've been doing it for a long time, it's still painful. And like people that are my age that have been trading since they came out of college still hit those like dark periods where you're like, shoot, I don't know if I can do this anymore. Cause like I've really been sucking for the last, whatever, say if you've been doing it for 20 years, that window has to be a bit wider before you start getting concerned. But say you've been trading for 20 years and then you have like an 18-month rough patch, you're like, shoot, maybe I'm not good at this anymore. So, but I think all that struggle and like those kind of difficult times, that's part of what makes trading awesome. And I mean, that's kind of like a thread in Alpha Trader is in my book, Alpha Trader, is like those, it's kind of like an analogy to life in general. Like that sounds a bit cheesy, but it's kind of like, you know, the hills and valleys. That's what my old boss said when I started, was like, when things are going bad, is like hills and valleys, man. Hills and valleys is just always hills and valleys. And you just, sometimes you have to keep grinding to get through.
Yep. 100%. And, you know, when you think about another thing, so do you think that, you know, market regimes as a whole, you know, do you think they're changing more frequently compared to when you got started? Or do you think, you know, how do you actually think about market regimes?
So interesting. We didn't prepare for this thing to be about adaptation, but obviously that's a theme that I'm big on, because I think that's like an important thing that a good trader adapts to new regimes. So obviously one of the big regime shifts was electronification, which we talked about. And then within that, I think the most important regime, there's a lot of different ways you can slice and dice regimes, or what are different regimes. But I would say like the primary way that you slice and dice it is volatility. And so the simplest way to look at that is like fast markets and not fast markets. And I think that's like a gross simplification. And obviously there's a continuum, you know, VIX 28 is different from VIX 22, but if you look at it, I think the simplest way to think about it is in terms of VIX, because most people will know what that means. And so one thing that a lot of people are not good at is adjusting to different volatility regimes. So there's a bunch of things that you can do to adapt, but one of them is obviously the most important thing is probably position sizing. So a lot of people just always trade the same position size. And like, that just makes absolutely no sense. Your position size should be reflective of what the volatility is. And, you know, if VIX is at 80, you're not trading the same number of S&P futures as when VIX is at 12. And if you are, you're probably going to blow up. And so I think people tend to either not change their position size at all, which is like, that's obviously the worst, or they're too slow and not dynamic enough. So it's pretty easy to just size your position based on volatility. Like, I think that's kind of like a basic thing that everyone should be doing. So that's one kind of regime, is volatility. And then for my style of trading, I trade a lot of correlation, which people call lead lag. So looking at a whole bunch of markets to try and get clues as to what my market should be doing. So like, the simplest example would be to look at a commodity currency like Aussie, and then say, okay, what are their main exports? Gold, iron ore, copper, etc.
Mm-hmm.
And how are those performing on an intraday basis? And then how's the currency performing? And that's like a simplistic one, but there's a lot of different ways. If you become really expert at one product or one market, then you should know the other things that are correlated to it. So even if you're trading single names, if you're trading one semiconductor name really actively, you should know the other six semis and probably like the other ecosystems around the semis, and have one eye on those things, because there's going to be a lot of sympathy between all markets. And there's a whole bunch of reasons that happens. Like the main one is just that the same thing is driving a lot of markets at the same time. So if you look at, say, Canada, you look at the Canadian dollar, Canadian interest rates, oil prices, and US growth. Those things are all kind of related in some kind of blobby kind of way. So if US growth is doing better and oil is going up, that's going to be good for Canada. And that's probably going to push Canadian rates and the Canadian dollar up. So looking at all those things can give you, it's kind of like forensics or whatever, right? You're like looking for all these clues and then trying to like solve for, okay, what's my thing going to do? To me, that's a really important part of being an expert in your market, whatever the thing is. Like if it's, for me, it's currencies, but if it's fixed income or whatever, is understanding like kind of the concentric circles that go around your market. So your market is the thing in the middle, and then those other things are going to be driven by a lot of the same variables, and also will drive your market, right? So there is some direct causation as well. Like if oil goes up, then Canadian oil producers will need to sell more dollar Canada. So that's like a direct cash flow way that the markets are connected. So there's a kind of like the third variable driving everything, which could be like the economy or whatever. Yep. And then there's the direct connections. So all that to say, in terms of regimes, correlation can be strong or weak, and can be like important or completely useless as a trading methodology. And so one mistake I've made a lot over the years is getting married to that methodology for just a bit too long, when like oil's going up and dollar CAD's going up, which would be unusual because usually oil would be good for Canada. If that's persisting, it's really hard to pick your moment where you go, okay, that correlation is busted. And it can be wrong to constantly jump around from correlation to correlation, because most of them have like an underlying economic reason. So determining what kind of regime you're in correlation wise, I think, is really important. And you can do that in a statistical or like an analytical way by looking at R squareds and that kind of stuff. And I think that's useful and important. But what I think for me is more important is understanding. So there's like an expression, it matters when it matters. So the ultimate example of that is current accounts. So like no one really gives a rat's ass about current accounts almost all of the time. And then once in a while, people are all worried about current accounts, especially in emerging markets. Yep. And nothing has actually changed below the surface. It's just that people care about it now. And you can either get frustrated by that, or more useful is to acknowledge that, things matter when they matter. And so a skill that I think I have and that is useful is to identify what correlations matter and what don't. And you could do that with, like I said, with statistical analysis, but the thing you have to remember is it's backward looking. So dollar CAD is 100 or was 100%. That doesn't mean in the future it's going to be. So having some rational view on whether correlation will continue or not is useful. And one way that you can do that is, like for me, is just a really simple way, is if oil's making new highs and it's in the news a lot, it's much more likely it'll be front of mind and correlations to oil will be high. If oil's been in a 42, 48 range for 6 weeks and it goes from 43 to 46, then the correlation's less likely to be high, because just no one really cares, right? Because it's not a big part of the narrative. So knowing the whole narrative and then what are the pieces of it can help you a lot with correlation. So yeah, those are like, I would say volatility and correlation are the most important things to understand regime wise, because a lot of other stuff flows out of that. Like
Yep.
liquidity is super important to know what kind of liquidity regime you're in, but
Hmm.
that's usually volatility and liquidity are so intrinsically,
Interconnected.
yeah, they're interconnected. So if you're right sizing for volatility and you understand volatility regimes, you're probably going to understand liquidity pretty well as well.
Absolutely. And what other strategies do you trade? So do you, so for example, in the art of currency trading, you talk about, for example, trading the news. So do you go about trading the news as well, or what other strategies do you trade?
Sure. So again, just like going back to, I don't mean to hammer this, but going back to adaptation, one thing that I really think is important is having a range of strategies, because you'll talk to someone who's like, I'm a really good breakout trader, but I suck in range bound markets. Or like, I'm really good in fast markets, but I'm not very good in like when VIX is at 12. That's not ideal. Like
Yep.
it's you can function in theory that way. I mean, I would say one specific strategy that you can do as a standalone is event trading, because that's a lot more dynamic and events are changing, and there's a lot more to that. But I would say overall, picking one strategy is not a good, in my opinion, and there's no right answer, but this is my opinion, is that picking one strategy as a discretionary trader is not the best way to approach markets. I think it's much better to pick one market, or like a few very connected markets, and then look at it more holistically and say, okay, well, is it in a range or is it in a trend? Is correlation high or is it low, and that kind of stuff. So, I mean, I use a lot of technical analysis. My view on technical analysis is kind of it's nuanced, because I have seen a lot of evidence. So one thing I really like doing is looking at common knowledge and then back testing it and seeing if it's true. Like when people say, "Oh, rates are going higher, sell stocks." Like, no, 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 that's not a thing. Like rates can go up and stocks can go up together or not. Like that's, so just looking at, so a lot of people have done this for technical analysis, and as a general conclusion, which you can read a lot of research and come to this conclusion, is that technical analysis isn't very good for forecasting. Most systems, like if you back test like Death Cross or Hindenburg Omen or any of those kind of things, anything like Head and Shoulders, most of them don't back test very well. So that kind of is like a strike against technical analysis. But then on the other hand, if you look at research of portfolio managers that use technical analysis, outperform those that don't. So like, why would that be? And the answer, I think, is that if you use technical analysis as a risk management tool, then you're a better trader, because you have firm parameters and reassessment triggers. And if you don't use technical analysis, then the risk is that you go like, oh, this stock, like I'm buying it at 10. Ooh, now it's at 8. It looks even better. Like, oh, love it at 6. That's the Lehman Brothers story right there. A lot of people bought Lehman Brothers stock at $4 because it looked cheap. But anyways, so what I think technical analysis for me is much more of a tactical and risk management tool. And I don't use it at all as a forecasting tool. So I will never look at a chart and say like, man, those, like that triple bottom looks juicy, I'm going to buy it. Although I will like see stuff, and obviously kind of will trigger some response in and make me interested. But
Mhm.
my trade ideas always come from like correlation, positioning, events, more macro kind of stuff. And then I use technicals more as like a drill down, like, okay, what's the best way to leverage this trade and make the most money if I'm correct? And also, at what point am I wrong? And so like, I think that from what I've seen from talking to, a lot of our clients are hedge funds, and from talking to a lot of successful hedge fund people, to me, that's the most successful model, is some kind of like macro or fundamental approach that's filtered with technical analysis. So it could be as simple as like, even if I don't think technicals need to be complicated as a risk management tool. So You can have some kind of very simple thing like we only go long when the 20 days above the 50 day. However, we only go long things that like stocks that we like for fundamental reasons.
Yep.
So that's kind of like my approach is more holistic. And so my edge specifically is, and what I think I make the most money and what I'm the best at is if you think of price as the sum of all the known information in the world, like that's the current equilibrium. And then as new information comes in, how will that equilibrium change and how will the price change? So what I try to do is understand the macro, and that includes things that are a bit less macro, like positioning being an important one. And then when new information comes in, if you have a really good sense of, okay, what was the prior equilibrium and what was positioning and what did people think and what was the narrative, then when new information comes, you have an edge in, reacting to that price. And that doesn't, or reacting ahead of the price change. And that doesn't always mean like, okay, FOMC came out and it's hawkish, so I'm going to sell euros. It doesn't, that it could mean that, but it can also mean, everyone went into FOMC short dollars and the FOMC is dovish, but I know people thought they might even be more dovish. And now the dollar's selling off, but like I call BS on this sell off because, gold isn't moving and fixed income hasn't reacted. And I know everyone already went in short dollars because I've been talking to a lot of people and I read all the stuff. So now I'm going to take the other side and I'm going to go long dollars into that as a mean reversion or like as a fade kind of trade. So it's really like looking at the existing macro on a really big picture. But then my time horizon when I trade is like 1 day to 7 days usually. So I'm kind of surfing the changes in the narratives, or even just like the juicy part of the narrative. Like, there's a new theme, and I think this is a really powerful theme, and people love this theme, but people haven't really put a lot of money to work on it yet. I think people are like 30% invested. So I'm going to go in and then I'll maybe try to ride it for 6 days and catch 1.5% in currency land. And then get out. And even then, I might still do, like, if it worked, I might try to buy that dip back to a moving average or something and do that same trade like 3 more times if I think it's a powerful trend. Like say like the RBA is turning, the Reserve Bank of Australia is turning, and they've been doing a lot of bond buying, and say they're turning to like signal rate hikes in 2022. That's not a thing right now. I'm just saying that's a possible thing that could be happening. Then I might be bullish Aussie for 2 months, but still I'll probably only hold it for like 3 or 4 days at a time. And I'll try and kind of optimize my tactics around using overbought and oversold and like buying dips to moving averages and things like that. So the risk doing that is that you sometimes miss like a bigger, more explosive move where like it rips, you make 1.5%, it rips 2%. And then it's hard to get back in. But to me, the beauty of having the shorter time horizon is that there's just so many trades. Like if you look across, like even if I'm only trading G10FX or a bit of EMFX, you think of all if you're just trying to risk, 60 basis points to make 1.3%, say on average or something like that, there's just so many of those moves that it makes it really easy to see something and miss it and go like, oh, well, whatever, that tomorrow there'll be another thing. Mm-hmm. Whereas I feel like when you're a big picture macro swing trader, the FOMO is so much stronger because depending on what kind of an institutional structure you're in, there's a lot of pressure to catch the macro trades, like the big macro trades. So then there's like, if something starts moving 3% and you see a lot of FOMO trades just come in because people are like, shoot, my boss is going to think I'm an idiot if I miss this, the turn in the Fed. Yep. I can't miss the turn in the Fed. I'm like a macro guy at a giant hedge fund or whatever. Yep. So for me, my life is just a lot easier because I don't really, I mean, of course, like I'm a human being. I'm going to be sad if I miss something that I had thought of before, but at the same time, if you're trading like under 1 week time horizon, there's just so many opportunities that I don't get too sad anymore if I miss something.
Got it. So, at the start of this answer, you said that, macro strategies and, event-driven strategies are overall pretty good. So, could you give us an example of sort of an event-driven trade or a news-driven trade that you were able to catch? And could you sort of describe, how you found the trade, sort of your process in the middle and, how that ended up?
Sure. So the last FOMC I did well, and you asked me for a good trade, so I'm going to say this isn't a brag because there's plenty of trades when I lose money. But so going into the last FOMC, I feel like people at the turning point, the central bank turning points, are slow to change their view because, especially this has been the most epic. One, you could argue, one of the biggest monetary policy experiments in history, the Fed at average inflation targeting. And people have committed a lot of money to that trade, and to the reflation trade and crypto, dollar debasement and all that. So in a trade like that, I think there's going to be a lot of confirmation bias where you're going to need a lot of new information before people are willing to turn. So my view is that we've passed peak dollar debasement and we passed peak FOMC dovishness. And there's a bunch of reasons for that. I think one big clue was that when the Fed announced that they're going to start selling ETFs. I'm in the minority on that. Like, it didn't get crazy amounts of coverage. But to me, if you're a central bank and you're going into the market to sell assets, even if it's tiny, like the amount is very tiny, that is like a really strong signal that you're confident. Even if you're not like saying, okay, we're expressly sending a signal here, you don't do that unless you're confident. So, and then going into the FOMC meeting, people were still saying, well, it's very unlikely they'll do anything because average inflation targeting, and they're saying that inflation's transitory and all that. And so my view going in was that there's so many steps to unwind these programs that, like, the joke is like they're talking about tapering or whatever. So they can easily do a micro tweak to the policy and then say, well, we're not tightening. All we're doing is like reducing from like ludicrous mode to ridiculous mode is essentially what I would say they were going. So into that, I felt like people were in denial a little bit, that there was quite a bit of evidence, and some of the speakers as well, like Brainerd, for example. And I don't mean to go into the nitty gritty of all the details because that's boring, but the reason I'll try and like shed some light on the process that got me to the trade. And that might include some boring details. So another part of it, of the process there, was if you read Brainerd's speeches. So I think, like, for an FX or anyone that's trading macro, and I say this in the books, is you have to do the work. And some of the really basic work is boring, like reading the speeches from the central bankers. It's boring, but you absolutely have to do that. And if you're not even willing to do that, like, don't even bother trying to trade, in my opinion, because it's just like there's a lot of people that are doing the basic work. So if you're not, then like there's no chance. So in the Brainerd speeches, in the title of the third, like if you go 3 back, the title of it had the word patient recalibration or something. Then the next one still had the word patient like 4 or 5 times. And then her most recent speech didn't have the word patient in it at all. And she's in the core of the FOMC. So she's important. And then Clarida was like a little bit less dovish as well. So when you started looking at like, okay, we have market positionings pretty heavily short dollars. People are still committed to that intellectually, but yet the evidence to me is kind of showing, I don't think the Fed is like quite as pedal to the metal as all these people. So when you see a disconnect between the narrative and the positioning, and then an event will potentially crystallize that, that's like the dream scenario. Because the problem with when you just see a disconnect between the narrative and the like, so just to interrupt myself for 1 sec, there's this saying that the price is always right, or the market's never wrong. To me, that is not true. Like, the times when you actually make the most money is when the market's wrong. And I mean, I don't need to go through the history. The market's wrong all the time, like, in my opinion anyways. So identifying those moments when you have a strong contrarian view to what the market thinks, or contrary view to what the market thinks, and you have a good understanding of why that might be the case, I think those are really good trade setups. So in that situation, if you have like, okay, the narrative looks like the Fed's kind of getting a little nervous about about the magnitude of these inflation surprises, even if they're transitory. And yet the market seems kind of committed to this dollar debasement trade. That on its own is harder to trade if there's no event coming up, because then you're like, yeah, this could just keep on, this disconnect can get wider and wider, right?
Yep.
And a good example of that is the China credit impulse has been slowing for many, many months. And like, I kind of was latching onto that for a while in earlier in 2021. And then it's like, okay, nobody cares. So at some point I got to stop caring, because I'm like literally the only person in the world that seems to care about this.
Yep.
So finding the time when this, like, okay, now the market cares, but they didn't care yesterday. The most likely point for that is going to be an event. So like, that's kind of the dream scenario, is when you have that big disconnect, but then there's an event coming up that might square those two things. Which is like your view of what's going on, and the market's view, which is over here.
Mm-hmm.
So then in this case, so I went into the FOMC long dollars, thinking that the FOMC would be more hawkish, and generally that is the way that the FX markets would respond to that, is through a higher dollar, so higher US rates and higher dollar. And so, but then there's two ways, as like a fast money kind of person, you can go into that. You can go in either like, okay, here's my position, and if I'm right, I'm going to add, or here's my position, if I'm wrong, I'm going to cut. Because like, really, you can, for the way that my screens and everything are structured, you got to pick one side to be the fastest, because we're talking about like not milliseconds, but seconds you have to react. So in this case, I felt like it was a really good setup, and I felt, because the market was already short dollars, that if the FOMC was dovish, I wasn't going to get completely destroyed. So I was actually ready to just add. Mm-hmm. So when the dots moved up, it was like really binary looking thing. And generally what I'll do is I'll also have the other markets up, because like a lot of times the HFTs are always going to do the textual processing quicker than you can even read the headlines. So sometimes it's actually better to just look at the other markets, and you see like, okay, gold down $20, fixed like TYs, which is 10-year futures. TYs down 10 ticks, just sell euros, sell Aussie without even reading the text. That's kind of like would be more the way I would react. So in this case, I was ready for that. TY dropped like 12 ticks instantaneously, which is the HFTs reading the text faster than any human can read it, and selling the futures. So then I sold more euros, and then and in that case, I think I don't totally remember. I think I held on to it for like maybe decent amount of time, but like less than 24 hours. I think I held it for like 18 hours or something. And yeah, that was a really good trade. And that's kind of like, for me, that's sort of textbook of, there's a disconnect between what the market thinks and what I think. And that was the ideal scenario, because you had the catalyst. And then just like a little extra bit of like how I look at it is, generally then what I'll think about is, okay, dollar ripped and then it went stronger into the close. Then the first thing I'm going to look for after that is like, I'm staying like maximum long dollars at that point, is how does Asia treat the move? Do they want to go with it, or do they want to take the other side? Because in FX, there's a lot of time zone differential. So generally, whenever you flip to a new time zone, I always think, okay, like now my mind is kind of open to like, what is it going to mean revert, or is it going to continue? And specifically, Asia is like, each time zone has its own nuances, but Asia tends to be a lot about central banks. So like, are the central banks going to buy dollars or sell dollars here? Because if they come in like raging sell dollars, like obviously that's not good for my thesis, because maybe all the specs that we're getting out are now just pounding the central banks, and the central banks just hold it, and my view's done. So then it might be quicker. But in this case, Asia bought dollars, and then so that was like a little bit of kind of fuel to the fire, and also raised my confidence. And then that gives you the chance to then you maybe move your stop to a point where you're still going to be up decent, or like better than flat if it all goes terribly wrong. Because one thing that does happen a lot with those, like what looks like a watershed event, is that it's not. And payrolls is a good example of this. Many extremes I think payrolls is the best example, because it's just the importance of payrolls in terms of how we trade it, and
Mhm.
importance of payrolls in terms of like, is it a reliable economic indicator? There's a pretty big disconnect there. Like people trade it like a 10 out of 10, and really like over 12 months, if you take the average, it's an excellent indicator, but any given payrolls number has so much noise that it's like borderline useless. So the way that the market, the reason that's the reason that a lot of times the extremes reached on payrolls are reversed in the week that follows, and also people have the weekend to kind of chew on it. So whereas a hawkish FOMC is likely to be more of like a watershedy kind of event, so I'll be more likely to hold on to it. Whereas something like payrolls, if I caught payrolls and like say I predicted payrolls was going to be strong, and I added, and then I'd be much more likely to just get out at 3 p.m. or 4 p.m. On the day.
Got it. Got it. Got it. And when you sort of express these trades, do you usually express it as, say, a basket of currencies against the USD, or do you tend to use technical analysis or something and then pick one currency to trade?
I'll do both. So the good thing about baskets is that, so one unique thing about FX, this is kind of like for newer people that don't trade a lot of FX. Anyone that trades FX would know this, so I'll keep it short. But the main feature of FX that's different from other assets is that the numerator and the denominator are both important. So if you're trading Aussie against Kiwi, which is New Zealand dollar, then there's kind of two stories that you're matching up. The
Yep.
analogy in crypto would be like, normally people are trading Bitcoin or Ethereum or whatever against the dollar. So it's just like, do I think Bitcoin or crypto is going up or down? But if you do like Bitcoin against Polygon, then you're kind of like, now there's two stories, and I'm really contrasting, or like the flippening kind of stuff is
Hmm.
all about the contrast, the contrast between the two stories.
Yep.
And that's what currencies are about, right? So say I have a dollar view into an event, then in that case, like through an event, it's not very important what you pick because it's just going to be an across the board dollar move. But if I have a 1 week view on Australian dollar and I have no view on the US dollar, then the risk of like, okay, say I think Aussie's going up and I buy Aussie dollar, and then the Fed is hawkish, Aussie dollar is going down no matter what I thought about Australia. So then I have the denominator wrong, and it doesn't matter if my numerator calls right and RBA's hawkish, then I'm going to lose money. So in that case, like basically the longer my time horizon and the more idiosyncratic the story is, then the more I tend to do a basket. So like if I think the New Zealand economy is going to outperform and the RBNZ is going to react to that at next week's meeting, then like I don't really want any dollar exposure, yen exposure. What I really want is just keep like New Zealand exposure, right? And the only way to get that is to then do a basket. So there's a point of diminishing returns where like doing New Zealand against 9 currencies isn't worth it. So
Yep.
like usually I'll do 2 or 3, maybe 4 currencies at the most. There's also sometimes like capacity and execution reasons you'll do that. Like if you're working at a big hedge fund and you want to take a big dollar view, you might be better doing like $200 yen, 200 euros, and $200 Canada, and not like $600 Canada, because you're going to hit some kind of capacity and liquidity constraints. So there's a few reasons to do baskets other than just smoothing out the idiosyncratic risk. But I would say mostly when you say basket, like yes, I'm doing a basket, but it's like 2 or 3 currencies. So it's not like necessarily as diversified as people would think a basket would be.
Got it.
It's also a pain in the butt to, if you do a real like a basket of 9 currencies,
Yep.
and then like something huge comes out and you're wrong. It's just a lot of buttons to press to get out. It's just, so it's not as practical to do like a true basket either.
Yep. Yep. And one thing that we have seen in equity markets is sort of the impact of market makers and their hedging and so on, and that's sort of actually driving stock prices. So, what is the impact of market makers on FX markets, and what are the major misconceptions most people have on how market makers actually operate?
Um, So I will say the number one misconception that people have is, because I've seen like books about this and stuff, is that dealers go after stop losses of retail traders. 100% that is not a thing. Like I, as a person sitting on a market making desk, have no idea where retail stops are.
Yep.
And it also, if you think about the capacity of any trade like that, like say, I think there's a lot of stops below oh 05. If I'm selling at oh 04 to trigger those stops, it's going to be very difficult for me to then buy back at oh 02 or oh 01. And the this just moves from stop losses in general aren't big enough to make it worth it. So like what any trader will do, including market makers, is like say, okay, that's a huge level. I think if we break that, there's going to be a lot of follow through, and that it would be a reasonable strategy for a market maker. But honestly, the strategies that market makers are using tend to be similar, except obviously there's a lot more hedging going on, which is, that's just clients doing large trades, and then you're trying to say, okay, what's the best way to execute this over time? And honestly, so much of that has become automated anyways, that the impact is still just as big as it used to be, but it's very difficult to see it because a lot of it is sliced into micro, like TWAPs, which is like time weighted average price. A lot of even what you would think is human flow is actually becomes algorithmic by the time it hits the market. Mm-hmm. So even as an individual, like say, I think, the euro's going up and I want to buy euros. A lot of times if I think nothing's going on in the short run, I'll run an algorithm myself to buy the euros. So, and I guess the only relevant point to that is if you think you can see sometimes like something's been, and I think this is just basic technical analysis too, but sometimes you just see something going up like on a perfect 45-degree angle for 2 hours. That like people would tend to guess though that's probably like a very simple TWAP, just buying every time it gets to the moving average or whatever. But overall, I would say the flows are very important. Like what corporates are doing, what central banks are doing, and what hedge funds are doing, and what real money's doing, mm-hmm. are important. But they're all reacting to the same stimuli as an individual trader at home. So even the biggest corporation in the world that has massive hedging needs, they're still kind of looking at things in a similar way. So I would say it's not as different as people think. I think that a lot of the thought process, because like I traded my own money too, and a lot of the thought processes are I would say more similar.
Got it. So one thing that's changed from say the 1980s and the 1990s is that sort of information on trading has become a lot more accessible. So you could go on the internet, you could read books by people like Brent, Donnelly, and you have all this information at your fingertips. So do you think the probability of becoming a self-sufficient, successful trader has gone up as a result of this, or do you think that it's actually gone down because now this means that there's going to be increased competition, which makes markets harder? And and as a follow-up to that, if you were starting to trade today, how would you go about learning to trade?
So to the first question, I think it's kind of a tie. So you have access to so much more information to play a game that is so much more difficult. So if you were really, really good in the 80s, it's probably the same as being really, really good now. It just looks a lot different because you're processing a lot different information. So like the idea that it's been democratized, I think is somewhat accurate because, even when I was doing the day trading, that was when the level 2 screen for the NASDAQ became available. And I think that was like a pretty incremental change and transparency for individual traders. But obviously like any new piece of information that comes gets arbitraged away pretty quickly because everyone has access to it. So, yep. I would say it's kind of a boring answer, but I would say that that having more information is an advantage, but you're playing a much more difficult game. So it ends up being a tie. And what was the second question?
And then the second question was, if you were starting to trade today, how would you go about learning to trade? Especially because, I'm 17, so I thought I'd ask you that.
Sure. So I think the best way to approach it is to come in with a lot of intellectual curiosity and a lot of realism that very few people succeed at it. And that's mm-hmm. just the way, right? Like, and that's, to me, that shouldn't be like a reason not to do it. It's like saying, your kid wants to be Major League Baseball player. and you say, okay, listen, it's going to be really hard and not very many people are going to make it to the major leagues, you're not telling them don't try. You're actually just saying, here's the realistic situation. And the takeaway should be that you got to work really hard and be realistic about what it's going to happen. And so what that means is there's a certain amount of time that you have to devote to. And so I think the best way to climb the mountain the fastest, and I mentioned this earlier, is to pick something and say, like, I'm going to be expert at this thing. And even if you're 17, like that probably sounds a bit crazy. Like, I'm going to be expert at TY futures or whatever. It's not that crazy because a lot of people are not expert. A lot of people trade a lot of products, and a lot of people just don't work as hard as the top tier of people, right? So there's just like in high school or in university or on Wall Street, there's still some people that work harder, and there's some people that are smarter, and some people that adapt better. And to me, it's not so much about intelligence. Like, I think there's a minimum bar of intelligence that you need to have as a trader, but I think it's a lot more about developing a process that gives you an edge, which, granted, I understand is difficult, especially when you're new, to even understand what that means. But so studying, and there's also, you can only learn so much from books and videos and stuff. I think also opening a real account, no matter how small it is really useful, because like I just always felt like when I've trained new traders that come to banks that I work at, I try not to really have them paper trade at all or for a very short time. I think a lot of the nuance or a lot of the challenge of trading is psychological, and doing stupid things that you shouldn't be doing is, that's weirdly, like, knowing the rules is pretty easy. You can read some books and get some ideas. But actually going out there, and it's something that's really hard for people to understand, is like mistakes you're making while you're making them. And I've been doing this for 25 years, and sometimes still I'll literally turn to a person next to me and say, like, I'm bearish and I'm long right now, and I have no idea how I got long because I'm bearish. Like, and that's after 25 years. So part of the biggest hurdle is all these weird psychological things that tricks that your mind plays on you. So you don't learn any of that by paper trading. You learn it by trading for real. Now, the only problem with that is you want to start with a small account, because you're basically thinking like, okay, this is tuition, and like paying 20 grand for a course to me is like almost for sure going to have negative expected value compared to putting like 4 grand in a trading account and being really committed to trading full time if possible. And learning one product really well, and until you kind of feel like, oh, I know this is going to go up before it goes up, because you have such a good feel for it. And I don't mean just reading the price action, but also like just understanding what's driving your thing, and looking at the other variables, and you see the other variables move and your thing hasn't moved, and all that kind of thing. So I would say that having a real account is important. But the problem is that if your account is too small, it's just gambling, right? Like if you open an account with $100, it's just meaningless. Like, depending on your state of financial well-being, there's a point where the account's so small that it's just meaningless, and you're just going to be trying to double it and double it again. And that's not trading. Then you might as well like bet on the Yankees game or whatever. So I think the realistic way, other than coming to a bank or hedge fund and usually the way to do that is through an analyst program, by getting good grades in school and then applying to a bank, is to commit to a longer, like to playing the long game and saying, okay, over the next, I'm just picking an arbitrary time window, but like over the next 4 years, I'm going to save enough money and I'm going to study. And then like, say you're working, like a lot of people are working full time, and I don't think you can trade part-time. I just don't believe that's possible. Like, I'm sure somebody out there has done it at some point, but as an exercise in probability, I think that it's like not even worth considering. So to succeed at trading, you need to do it full time. And that doesn't mean that you need to quit your job today. I think what it means is, okay, I'm going to build up, I'm going to save 25 grand, let's say, over the next like I'm just picking numbers. Obviously everyone's situation is different, but say you have a decent full-time job, you say, okay, I'm going to save 25 grand over the next 2 years. I'm going to read every good trading book about, that's within the realm of what I'm interested in.
Mhm.
And I'm going to spend, without jeopardizing my professionalism at my existing job, I'm going to spend as much time as I can watching like one or two markets and trying to dig as deeply as possible into like,
What's
because what you
driving it?
want to, yeah. And if you're gonna be okay, you're gonna pick one stock, then you want to study the options market for that stock as well, right? And all the markets that are related to that. And then sometimes you can get an idea like, oh, there's tons of bids for calls and nobody's selling puts or whatever. You can start to sometimes by the correlated markets can give you clues about your market. So I would say like if someone wants to become a trader and starting from nothing, you have to play a bit of a long game and say, I'm going to gather experience. I'm going to save enough money to have a meaningful account. And then I'm going to start trading for real full time. And I'm going to go into it knowing like, shoot, 5% of people succeed at this thing. If you look at success as meaning like not just 1 or 2 years, but an actual career where you out earn what you could have earned in another occupation, the success rate is low. And you just go in with eyes wide open and say, okay, I know I'm doing a really hard thing. Just like if you're going to write a book of fiction and you want it to be a huge success, or you're going to go play poker on the circuit, you go into the casino that first day with a realistic view that, I'm going to have to grind like crazy for a couple of years, 3-4 years, and slowly up the stakes until I'm sitting at the table with the big boys. And maybe, if I'm lucky and I work hard enough, then the chips will fall in the right way and I'll be successful.
Absolutely. Yep. Well, Brent, thank you so much for being on the podcast. It was awesome having you.
You're welcome.
Yep. Thank you.
All right. Thanks for having me.